Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Invitae stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Invitae is a genetic information company. It has a testing delivery platform that is accessible to patients. It provides genetic information more efficiently than its competitors. The company was a subsidiary of Genomic Health in 2010. Then it spun off in 2012. In 2017, Invitae acquired Good Start Genetics and CombiMatrix. In 2020, it announced the acquisition of ArcherDX for $1.4 billion. Last year, they acquired healthcare AI startup Ciitizen for $325 million. The company is headquartered in San Francisco, California, and was founded in 2010. The ticker trades on the New York Stock Exchange, Deutsche Borse, Mexican Bolsa, and London Stock Exchange. Let's get started with the model. This is a small cap company, 1.2 billion market cap. They're trading at $5 a share, and they have 229 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have negative free cash flow each year since they're still growing their revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is a sales for the company, and that triples from 2018 to 2021. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grows each year from 68 million to 112 million. Below that is their operating expenses, and their operating expenses are higher than their gross profit, so they have negative operating income each year, and the negative is getting worse every year. Below that is the interest they pay in their debt, which was the most in 2021 at 50 million. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. An example of something in this category is a gain on the sale of an investment. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is negative every year. This is the company's income statement from their latest 10K. This gives us 2019, 2020, and 2021. Their revenue in 2021 was 460 million. Which is pretty close to 2019 and 2020 combined. Here's a breakdown of their revenue by country. The US is 404 million, Canada is 8 million, and the rest of the world is about 49 million. A bulk of their revenue is through insurance, 277 million. Some patients pay directly out of pocket, that's 42 million. And they receive 53 million from partnering with other companies. They partner with some big companies, AstraZeneca, Illumina, Merck, and other business-to-business revenue is 89 million. Cost of revenue is 349 million. Their biggest expense is R&D, 416 million, marketing, 226 million, general and administrative, 248 million. The change in contingent consideration is negative 386 million. They probably have a contract with another pharmaceutical company, so of course they have a net loss every year. They have the best loss per share in 2021 at 180. Last year it was 447, before that it was 266. The reason it's better in 2021 is because they have so many more shares outstanding than prior years, 211 million. In 2020 it was 135 million, 2019 it was 91 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. They spent 55 million in CapEx in 2021. CapEx are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Since they have negative free cash flow each year, they're running their business on equity and debt. They issued 130 million of equity in 2018, 213 million, 548 million, and 458 million. Every time a company issues common stock, it increases the shares outstanding. It makes your shares less valuable. They're also adding a lot of debt. They added over 1 billion in 2021, and each year they add a good amount of debt. This is the operating section on their statement of cash flows, and the way you calculate operating cash flow, you start with your net loss, then you add or subtract the non-cash items on the income statement. We have to add back stock-based compensation of $180 million. Then they had to remeasure the liabilities from an acquisition that was negative $411 million. So they lost $560 million of cash flow in 2021. In 2020, they lost $300 million. In 2019, they lost $145 million. This is the investing and financing sections on their statement of cash flows. In their investing section, they bought $326 million of short-term marketable securities. $425 million of marketable securities matured. They spent $250 million in business acquisitions. Last year was $383 million. They spent $55 million in CapEx in 2021. In 2020, it was $23 million. So in their investing section, they had a cash outflow of $200 million. Last year was a cash outflow of $401 million. In their financing section, they added $430 million of equity, and they also added $1.1 billion of debt. So in their financing section, they had a cash inflow of $1.6 billion. This is the equity section on their 12/31 balance sheet. They have $3 billion of equity. They raised $4.7 billion from selling their business, and they lost $1.7 billion from running their business. Let's look at the capital structure. $3 billion of equity, $1.7 billion of debt. They're 63% equity, 37% debt. And their net debt is $679 million. This is their capital structure since 2015. And you can see their equity balance is getting higher. That's because they're adding so much debt and common stock. This red line is their debt balance, and the green line is their cash balance. I gave them the middle whack on Finbox, 13.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $900 million. We divide that by 229 million shares. And we get a calculated stock price of $4. They're trading at $5, so they're trading at a 29% premium. It's a sell according to the model. Their revenue is projected to be $1.1 billion by 2024, $871 million by 2023, and $641 million by 2022. That's how I got their future revenue estimates. And to get their 2025 revenue, I just grew it at a similar pace. My calculation for 2025 is $1.37 billion. The average company in their industry converts 18% of their revenue into free cash flow. So I multiplied their 2025 revenue by 18%. That's how I got their future free cash flows. And I just assumed they would have negative free cash flow up through 2024. 6 analysts priced this stock, and the average price target is much higher than me at $16. The low is 10, the high is 25. Look how high the stock price was in the beginning of 2021. It was well over $50 a share. It really came down a lot since that point. They have a beta of 1.75, so the stock is a bit volatile. It moves about 2 times the market. It's gone down 86% in the past 52 weeks, while the S&P is flat. The 52-week low is $5, the high is $38. And the stock is trading well below its 50-day and 200-day moving average. 6 million shares are traded each day on this stock. Of the 229 million shares outstanding, 215 million are on float. 85% are held by institutions, and it has a high short percentage. Over 14% of the shares are shorted. A really good sign is they're adding employees every single year. They're up to 3,000 workers. If you put $10,000 into this company when they started trading, you'd be at $3,000 today. That's a 71% loss. But at this time last year, your $10,000 would have been close to $30,000. The CEO's salary is $450,000, and their total compensation is $3.9 million. In the past 12 months, there's been no insider buying, just selling. 75,000 shares, 56,000 shares, 100,000 shares have been sold. Here's a list of all the people that sold in the past 12 months, the date, the person, the number of shares, and the price. Look at all these people who sold for $20 or $30 a share. They must be really happy today. 78% of the companies held by institutions, 16% by the general public, 5% by venture capital and private equity firms, and 0.6% by insiders. The famous investor Cathie Wood, her fund owns 12% of the company. The next biggest shareholder is Vanguard at 8.5%, Nikko Asset Management, BlackRock, and Kasdan Capital. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a pretty good price to sales of 2.5, that's stock price over sales per share. The market median is 2.8, the average is 9.5. They have a really good price to book of 0.4, that's stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet, it's assets minus liabilities. And they have $3 billion of equity. But since they acquired so many businesses, they have negative tangible equity. Their tangible book value is negative $500 million. We cannot look at their price to free cash flow since they have negative free cash flow. Let's look at their non-current assets. $115 million of property and equipment, $120 million of operating leases. This is the value of the assets they lease. They have $10 million of restricted cash. Restricted cash is cash that's set aside for a specific purpose. $1.2 billion of intangible assets. $2.3 billion of goodwill. Goodwill is the premium you pay when you acquire another company. And $24 million of other assets. Let's look at their non-current liabilities. They owe $124 million on their operating leases. They owe $6 million on their finance leases. They have $113 million of debt. $1.5 billion of convertible notes. Convertible notes are dilutive. The owner of the note can convert the debt to equity at any time they want. They have $52 million of deferred tax liabilities. This should increase their taxes in the future, and $38 million of other. They have a high current ratio of 8.2, that's current assets over current liabilities. And their quick ratio is 7.9. Let's look at their current assets. $920 million of cash, $122 million of marketable securities. These are highly liquid securities like commercial paper or treasury bonds. Their customers owe them $66 million. They have $34 million of inventory and $34 million of prepaid expenses. A prepaid expense is when a company makes an advance payment for a product or service they're going to receive in the future. Let's look at their current liabilities. They owe their vendors $21 million, $106 million of accrued liabilities. These are expenses the company has incurred but it has not paid it yet. They owe $12 million on operating leases over the next 12 months, and they owe $4 million on their financing leases over the next 12 months. An operating lease and finance lease are very similar. You're leasing an asset, but at the end of the lease term for the operating lease, you give the asset back. At the end of the lease term for the finance lease, you have the option to purchase the asset. In 2021, they had negative $615 million of free cash flow, and they currently have over $1 billion of working capital. Working capital is current assets minus current liabilities. So they may have enough funding to get through the next 12 months without adding any debt or equity. The best way to look at ratios is to compare them to companies in the same industry. There are 83 companies in the same industry as Invitae, and Invitae ranks 34th in market cap at $1.2 billion. The average is $9.2 billion. And it's really hard to look at their numbers because they're a really small company. They are doing a lot better in price to sales than the average company. And their 3-year annual revenue growth rate is 46%, which is more than double average. So to summarize, I have them trading at a 29% premium, but it's almost impossible to value a company like this. The stock could easily 10, 20, or 30x, or never go anywhere. It really depends on how they improve their technology and how well they scale it. I rank their free cash flows 1 out of 10, their revenue 5 out of 10, and their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.